Hello, welcome. Welcome to the introductory problem for Chapter 7. It's an exercise this week. It's exercise 7.7a on page 389 at the back. And so here on the screen you can see it's our Chapter 7 introductory problem, exercise 7.7a. This is our general journal where we're asked in the first requirement to write some general journal entries. So we have the name of the company, we have the general journal title, the dates, the accounts, the debits and credits. So just as you've been seeing these all along. So here is 7.7a, accounting for uncollectible accounts, percent of receivable allowance method. Tyler Service Company experienced the following transactions for 2013. Its first year of operations, provided $86,000 of services on account, meaning for credit on accounts receivable, collected $72,000 of cash from accounts receivable, paid $39,000 of salary expense for the year. Tyler adjusted the accounts using the following information from the accounts receivable, and so we have 0 to 30, 31 to 60 days, and 61 to 90 days, and 91 and over 90 days. Now, if you're looking at this problem and you haven't read the chapter, you haven't listened to the videos, this data is not going to be very meaningful to you. You need to look back at page 371 and look at the table at the top of Exhibit 7.3 to get an idea where these numbers even come from. So before we go any farther, be sure that you look at those and get those numbers. And then when you look at Exhibit 7.4, you'll notice that we have these categories of accounts receivable, and we know the total amount of money in each of these age categories. And so we have to weight those categories by the probability of loss. So we have a percentage probability of loss that's given to us for each category. So looking still at page 371, notice that we're multiplying these because we're weighting them by the probability of loss. So we're multiplying the amount of money we have at 30 days times its probability of loss, and the amount of money we have at 90 days and by its probability of loss, and getting a number. And then we're summing all of those dollar amounts of the probability of loss to get a number that represents the amount we want in the allowance for doubtful accounts. So as you look at $373,760 on Exhibit 7.4, that's the amount we want in our allowance for doubtful accounts. So that gives you a background of where this table's coming from. Now then, for the solution, we will need to weight these amounts by their probability of loss to get an allowance balance. That's something we're going to have to do. So as we look at the requirements, record the above transactions in general journal form and post them to T accounts. Prepare the income statement. What is the net realizable value of accounts receivable? So this first journal entry that we have right here, we're going to be debiting accounts receivable and crediting sales for $86,000 because service revenue was $86,000. So I'm going to bring that up above my head a bit so you can see it here. Then we said in event 2, we collected accounts receivable. So we're going to be debiting cash and crediting receivables for $72,000 for the amount that we collected from our customers. And then we're going to pay our salaries, so we're going to debit salary expense and credit cash for $39,000 for the amount of the sales. And then we're going to have our uncollectible account expense, and we're going to be putting that into our contra asset allowance for doubtful accounts. Now, in order to do that, we have to set up a table like you see here. And here are the categories of the age of the account receivable. Here's the amount of money that's in the account receivable. here's the percentage that's likely to not be collected, and then we multiply the probability of loss times the amount to get the dollar equivalent value for that category. So we get $75 at 1% of loss, we get $100 at 5% of loss, we get $150 at 10% of loss, we get $300 at 30% of loss, and we get $1,000 at 50% of loss. And so we need $1,625 in our allowance for doubtful accounts. Now, if we need $1,625 in our allowance for doubtful accounts, and we have no allowance number given to us, we have to assume that it was 0. So we need to move the allowance for doubtful accounts from 0 up to $1,625. Allowance for doubtful accounts is a contra asset, carries a credit balance. The credit balance is 0. We want the balance to be $1,625. So we're going to have to credit the allowance for doubtful accounts for $1,625. The purpose of this adjusting entry is to recognize the probable loss from our accounts receivable credit sales. And so that's going to be to uncollectible account expense. It's an expense. It's going up. You debit an expense to increase it. So we're going to debit uncollectible account expense for $1,625 based on the schedule that we prepared. And then we're going to credit the allowance for doubtful accounts for $1,625 to make that allowance go up to the amount we expect to collect. So that is those are the journal entries, 3 of them for transaction events, 1 of them for an adjusting entry at year end for the probable loss due to our credit sales. So then in part 2, it asks us to post those to our T accounts. So here's our T accounts for 2013. Remember, they're assets, liabilities, and owner's equity. So all the asset T accounts are over here on the left-hand side. The revenues and expenses are over here on the right-hand side, and they're going to go ultimately into retained earnings through the closing accounts. So we have cash. It had a positive of $7,200, a debit of $7,200, a credit of $39,000, and a balance of $33,000. Accounts receivable had a debit of $86,000 and a credit of $72,000, giving us a balance of $14,000. The allowance for doubtful accounts had a 0 balance. We credited it for $16,500, so now it has a credit balance of $16,500. The accounts receivable less the allowance is going to give us the net realizable value, or the cash equivalency value, the book value. We call them all of those, face value, call them all those terms. Accounts receivable less the allowance, debit balance minus credit balance, to get the cash equivalency value, how much we actually think we're going to collect on our accounts receivable. Now over here we have service revenue of $86,000. We have an expense of $39,000 and an expense of $1,625. So the difference between those are going to give us our net income. So now we use those T accounts and we prepare an income statement. So here's the Tyler Company income statement, $86,000 in the revenues, expenses of $39,000 and $1,625 for a negative minus $40,625 in expenses, and a net income of $45,375. So this is just a standard net income statement that you've been seeing all along, just pretty small, showing you just these introductory transactions. Now, what would the balance sheet look like for the accounts receivable? Well, we would want We're always trying to get to their net realizable value. How much cash are we going to net out of these accounts receivable? What's their cash equivalency value? So for accounts receivable, we have $14,000 less the allowance for doubtful accounts, $1,625, for the net realizable value of $12,375. So that's the amount that we expect to realize, and that is requirement C, the net realizable value. Now this was actually this accounts receivable in this chapter. There's a lot of information here, a lot of explanation, but it's a pretty simple step up for you. The only new thing you're learning about here are these that some of these people aren't going to pay. There's going to be a loss, so we're going to need to recognize an expense. We can either recognize the expense using the allowance method or the direct write-off method. The direct write-off method is not acceptable because it doesn't give us an accurate matching of revenues and expenses. We would only use it if if accounts receivable were immaterial. And so we have to use then the allowance method. And we have two choices in this chapter. One is the percentage of credit sales, and the other one is the aging of accounts receivable to get a percentage of receivables that we expect to be collected. So as we look at these two methods, there's not a whole lot more here that for an introductory problem to show you. This one happened to do the aging method because it's more complex and I wanted you to see it, but here's how the accounts receivable are now being presented. Here's how the new expense is presented that you've learned in this chapter. T accounts, this contra asset has a credit balance. Get that up a little higher for you to see. This allowance for doubtful accounts, contra asset has a credit balance. And then this table to age accounts receivable. So that's how you would determine these journal entry amounts. This is the new adjusting entry for this chapter. So short, simple, easy. I hope that it really focuses tightly on the new aspects of accounts receivable that you're learning for Chapter 7. Thank you for joining me, and I'll see you as we do more work with Chapter 7.